Good day, and thank you to everyone joining us today for our webinar, Emerging Market CEF as Legacy Products, Part 2. Presenting for us today will be Barry Olive from City of London Investment Management. So at this time, I shall turn it over to Barry.
Thanks, Teresa. Good afternoon. I'd like to take a few moments of your time to talk about U.S. emerging market closed-end funds as legacy products. Little did we know when we were coining the title of this series of presentations back in March, how quickly the title would become relevant. Within a year, we're likely to have seen the disappearance of 9 separate U.S. emerging market closed-end funds, which, depending on which side of the fence you sit, represents an unsatisfactory or satisfactory outcome to what has been a checkered short-term history of trading U.S. emerging market closed-end funds. It's been unsatisfactory to directors who have lost their jobs, managers who've lost assets under management, and shareholders who have had to deal with discounts that in many instances approach 20%. Or, you might say, satisfactory to arbitrageurs who have benefited not just from appreciating NAVs, but also narrowing discounts. It's a shame that an industry that's well over 150 years old had seemed to have lost its ability to self-regulate. I hope that we can all agree that the outcome of the emerging markets bear market finished up by being significantly worse within the US emerging markets closed-end fund industry than if shares had been bought back for cancellation in the stock market by relevant closed-end funds. I'd like to discuss very briefly 9 points that, in my opinion, sum up some of the peculiarities of the US emerging market closed-end fund sector and its apparent inability to self-regulate. 1. Excessive length of service and lack of refreshment amongst boards. I guess this was caused by nomination committees that did not consider their responsibilities. 2. Use of plurality versus majority voting, presumably caused by a lack of awareness of the changing environment across corporate US. 3. Reluctance to use buyback facilities. We would say reduce the supply and the price goes up. 4. High expense ratios, a lack of resolve to provide value for investors. 5. Benchmarking against non-total return indices, boards allowing managers to pick the most favored or favorable benchmark. 6. Board members lacking investment expertise, interested board members, what we would call conflicted partisanship. 7. Allowing managers to maintain excessive unrealized gains. Enhanced assets equals enhanced fees equals enhanced inflexibility. 8. Ignoring non-binding proposals. Democracy rules, right? And 9. Working for management instead of shareholders. This was the core of the problem. Now, fortunately, the closed-end fund industry has over the years reinvented itself. And over the next few months, as the dust settles with regard to the first significant reconstruction of the emerging market closed-end fund asset class over the past 20 or so years, it'll be very interesting to see if the remaining legacy products get real and become competitive, or if they also disappear due to competitive pressure. If we, for a minute, could go back to 1999, when we first referenced discounts and discount controls and discount control mechanisms in our statement on corporate governance and voting intentions, we were doing this because we felt that there was a lack of awareness amongst directors that investors were looking to invest in what we can best define as proximity to the NAV. As we went about our work, specifically in the US, there seemed to be a lack of awareness amongst boards regarding why an investor would want to invest in Brazil, Russia, or China. While we would state that our returns needed to approximate a relevant index, it seemed that directors were not aware of either the exposure that they were overseeing or the returns that they were responsible for. Whilst it would not be possible to be specific, it was also around this time that we realized that many directors were relying on their managers and service providers to help carry out their responsibilities. We started to receive letters in response to our letters from non-investment individuals who had little knowledge of our industry. As we were learning our way into this industry, we found that US emerging market closed-end funds had significant legal bills. And as a conservatively run shop that doesn't do anything knowingly illegal, we could not understand how these bills were being incurred, why they were so substantial, and why they were being paid. Returning to my point of a few moments ago, those responses were, very often, not being written by directors. They were being written by service providers who we would argue didn't necessarily share the aims and views of the board and who were often seemingly unfamiliar with the fund's shareholders. Phrases such as "you are short-term" were a common refrain in these letters. In fact, we've been investors in many of these securities for well over 15 years. Now, we have consistently said that we have core values when it comes to corporate governance, and we have consistently documented these standards in our statements on corporate governance. To be called short-term when we've invested in this sector since our firm's founding in 1994, and having documented our core values since 1999, is the kind of easy throwaway comment that we hear from directors and their representatives. The fact is, though, that we're long-term, we're here for the foreseeable future, and we actually don't or can't invest anywhere else. When we sat down with a constructive mindset to assist in the thinking behind the proposed Everdene reorganization that was recently announced, we went through a detailed process to identify and then synthesize the factors that we believe define a successful closed-end fund board. And by definition, invariably, a successful closed-end fund board leads to a successful closed-end fund. The key factors we identified were as follows. There was a need for a significant tender to get supply and demand into equilibrium. There was a need for term limits, maximum of 3 terms of 3 years, 9 or a maximum of 10 years in total. A 10% discount control mechanism. Buybacks, when relevant, announced daily on website. No holding over of directors. 120 basis point total expense ratio. Majority voting for shareholders. No interested party directors to be nominated. No new directors should be appointed without shareholder approval. An explicit retirement age to be set. Transparency and good disclosure regarding director skills and contributions. There's a need for industry skills, i.e. closed-end fund and investment management skills. We consider those to be a distinct advantage. The board should be diverse, and directors are going to be expected to travel to meet with shareholders. We expect an active audit and nomination committee, and we think that there should be limited input from lawyers on investment matters. Chairmen should be writing their own letters or statements to shareholders. We would say that the above items represent the manifestation of our core values. As the emerging market closed-end funds within our investment universe matured, but failed to change with the times, we saw a gradual weakening of fiduciary awareness, accountability, and transparency, and were presented with an opportunity to purchase shares at a gradually wider and wider discount. In some instances, there was so little external demand from other sources that we were able to purchase positions across accounts at over 15 discounts that totaled, in certain instances, 45% of the entire closed-end fund. How could this be so when these assets were fully fungible and when most portfolios could have been sold within 2 days? Before I answer that question, I should say that I've been around this industry for well over 50 years. As all our company does is, as was referenced earlier, invest in closed-end funds, our interest is not just in its survival, but also its growth. Today I'm talking about emerging market closed-end funds, but for emerging market closed-end funds, you could also be listening to us talking about developed closed-end funds, bond fund closed-end funds, or other subsets of closed-end funds, of which there are many. As this is all we do, as I say, it's in our interest to be long-term, supportive of the industry, also to spend time as investment professionals and attempt to educate that industry. To the extent that the industry does not agree with our core values, it can fight us. To the extent that it agrees or is prepared to listen, then there is probably a chance to meet in the middle. I would like to take a moment to talk in more detail about the proposed Everdene reorganization. In our view, many of the funds proposed for consolidation were no longer sustainable. They had traded at excessively wide discounts for separate years, indicating a distinct lack of demand in the market. Further, the boards were reluctant to utilize the buyback facilities as it would decrease the size of the fund. It would also, they often argued, have the knock-on effect of increasing the total expense ratio. We, however, had difficulty accepting this argument as it implied that a circa 0.2% increase in the expense ratio could equate at the extreme to, say, a 5% increase in the discount. Moreover, the solution proposed by Everdene to merge 7 of these funds into one larger EM generalist fund with a 2-year capped total expense ratio and a discrete DCM, discount control mechanism, of 10%, in addition to several other aspects of the transaction, will, we believe, be positive for shareholders. They will benefit almost immediately from the capital gains distributions and the significant tender offer of the new fund. The reduction in supply may have the effect of narrowing discounts throughout the sector. Additionally, the discount control mechanism may prevent the excessive discounts of the past from returning. And finally, it's an opportunity for shareholders of closed-end funds currently outside the scope of the proposal to join in. If they or you as shareholders believe that there is a possibility of your shares or your company being a part of this transaction, then we would suggest that you should lobby your directors, because it might well be that your closed-end fund could join in. In conclusion, we would say that we're approximately halfway there. At the point last March, when we started to plan for stage 1 of this series, we felt that the only way to get the emerging market closed-end funds supply-demand relationship back into equilibrium was to get directors and their service providers to act conventionally and in the interests of shareholders. The other half of this project is going to require that directors start to accept that the assets that they oversee belong to shareholders, and that they will be held to account for failing to live up to shareholders' expectations. Thanks very much for listening.
Thank you, Barry, for that very informative presentation. Unfortunately, that is all the time we have for today. For anyone with questions, please send them to tbarrows@pristineadvisers.com, and we will be sure to follow up. There will be a replay available, and that link should be ready momentarily. This presentation also qualified for 1 CFP credit. For anyone interested in receiving that credit, again, email tbarrows@pristineadvisers.com. And thank you all for joining us. Have a good day.